Welcome to FX Options University, recorded live at the International Securities Exchange. FX options are a low-risk alternative to hedging currency moves in any market condition.
You know, let's start, though, by kind of explaining what's going on here by going from a 180-day chart. You know what, Rick, let's go back to a one-year chart so you can see just how significant this move is. Stick with a daily if you can. Yeah, 3 years today, that's fine as well. So take a look. We're talking about the yen, and notice that the chart is going down, but my language is going to be reversed here. The yen has gotten strong enough that we are basically at a 3-year high on the yen, which is, of course, a 3-year low or weakness for the dollar here. Now, the thing that I was talking to Rick about this earlier today, this is absolutely fascinating to me. As was mentioned when we were starting off here, that I lived in Japan for a couple of years, and I was getting paid in yen. And a strengthening yen was wonderful because I had student loans that needed to be paid off in dollars. And in the end, I was looking to buy my first house. I was in my mid-20s, so a strong yen was great. But now I want to take my wife and kids back to Japan to go see some of the sites, and I'm thinking, holy smokes, it's going to cost me a fortune just to stay the night or eat at a restaurant in Japan, because we're looking at 85.79 yen to buy $1. When I was there, it was about 126 yen to buy $1. So it's definitely something significant here from a fundamental point of view. We're at a 3-year low for the dollar here, or 3-year high for the yen. Now, what I'm starting to want, yeah.
Let me just ask you. I switched to 200-day daily. Are you seeing that 200-day daily on your side now? Okay, excellent. Thank you.
Yep, and we're still good. Yep, thank you, Rick. I appreciate that. Now, what I'm asking myself as a technician is I'm seeing that we're breaking down below support levels here. As a pure technician, what I would say is I'm thinking we're going lower. Once we've broken through the support point at about 86 or so, I'm thinking we're going to go lower. Now, there's something fundamental that's got me a little bit concerned about the trade and taking it as a strictly directional trade is, when will the Bank of Japan intervene? And that is one thing that is rather predominant about the yen and about the Japanese, is that they want the yen to be at a certain level that allows the businesses, the export companies, to maintain profitability, but also to build product that's going to be relevant for the next year. Very much like OPEC. If you ever listen to what OPEC says, and I find this to be rather clairvoyant, when OPEC says we're comfortable with a barrel of oil being between $70 and $80, well, somehow we end up being within those ranges. And how do they do that? They do that by turning on or turning off the amount of oil that is pumped out of the ground from OPEC nations. When the Japanese say that they're comfortable with the yen being, I'll throw a number out there, between 95 and 105, what they can do is they can buy up or sell off their own currency to somewhat drive the currency into that direction through creating their own supply and demand. So by looking at this 85.79, what I'm asking myself is, wow, this is making Japanese exports very expensive, which of course means that their competitors, Korean, German, products made in Mexico and whatnot, those are becoming better values than some of the Japanese products. So I'm wondering, are the Japanese going to intervene? Are they not going to intervene and let it continue to float? But what I'm looking at from a trade perspective here, and Rick, if you want to talk about the technical side, I'll quickly throw out what I'm thinking about. What if I were to use a strategy that was not dependent upon the yen getting any stronger or this chart going any lower? Instead, I could look at something like a credit spread, and I'll walk you through that here. Rick, be sure we save some time, but why don't you talk about what's going on technically with the moving averages and the role reversals, and I'll get into some strategy when you wrap that up.
Yeah, you bet. While you were speaking there, Sean, I drew a trend line in, and that trend line is sitting, let's see, let me grab where that trend line is. I think you'd mentioned 86. It's just 86 and change. And what I'm looking at, and by the way, folks, the reason that you're not seeing volume on here is simply because the currency pair itself is not trading here. It is the option. That's why we call these the ICEFX options. We take the currency pair for our analysis, but we actually place the trade on the option. So there's no volume on there, so don't be too concerned. In fact, I'll just pull that down a little bit. Now, from a technical standpoint, let me just ask you this. Take a step back and look at this from a bird's eye view. Would you call this overall, this is a 200-day daily, would you call this an uptrend, a downtrend, or sideways? Well, we pretty much run from about 85 to 95 here, and it, quite frankly, is all over the board. We've got certainly some short-term trends captured within this time range, but this is a volatile currency pair where the volatility is ranging in about a 10-point range here, roughly 85 to 95. Now, that being the case, the last time on this time view, the last time we hit this was back in late 2009, and notice how we had this downtrend from about 94 to 86, and then we have, what is this? It's an indecision candle. Now, you couldn't really make the case that we had support at that point, at least not from the view that we have here, because that was the first time it hit that. The currency pair bounces around, but look what happened recently now. Just back here in the middle of July, we came back down and hit a low, and look how tightly that low matches up to the low from December of 09. We got a little bit of a bounce off of that low, and just 3 days ago, on July 30th, we came back and retested it with what? Another indecision candle. Came back to test that. It looked like we were going to resume another bounce, and then today, so we're talking real time now, as we're looking at this on August 3rd, 2010, today we have what's referred to as a gap down below support. Now, this is significant. What this tells us is not only are the sellers able to push this down on an intraday trading basis, but they were able to actually move it from one trading session to another. So at this point, you have to take that as a bearish signal, and if you were to take a bearish position right now, then the way that you would manage risk is simply to say, well, the reason I would get into this trade would be if it is because it dropped below what was previously support. So how would I get out? When would I manage risk? Well, the reason for getting in is your reason for getting out. If you got in because support's broken, then you would manage risk. You would get out if this jumps back above that previous support. But the fact is, the expectation right now is we expect now for that $86 to establish itself as resistance, because that would that's what we refer to as the role reversal. Once support is broken, it tends to become resistance. Now look at this from a technical standpoint, from a long-term view, and it becomes pretty clear that this is a long-term downtrend. So who's strong, who's weak here? Well, because these are all U.S. dollar denominated, the dollar over the last 3 years has been losing ground against the yen. The yen has been the stronger of the two pairs. Now, Sean, what I'm going to do right now is, since we're just talking about the yucks, I'm going to go to another screen, and I'm going to pull up the option chain for that, just show folks just in this particular platform how we would actually execute that. So what we do is we look at an option chain. In this example, we're looking at the USD yen, $YUK. We simply put that in the symbol. What that's going to do for us is going to retrieve the option chain. And let's go out here to October. So we're just going to go out a couple of months here. It's got a little bit of a drag on this. I tell you what, you tell me what you'd like to look at, Sean. I'll go ahead and drive the option chain here if there's anything particular that you want to look at for this one.
Okay, yeah, and I wasn't sure if you were disconnected or not, but let's see if we can go ahead and throw out a theoretical strategy. So I'm going to look at some real numbers here, and I'm going to talk about a strategy. This is not a recommendation, but I want to walk you through how we can take that technical, we can take the fundamental, and we can build that into a strategy. So the strategy I'm going to look at in this case is I'm going to look at a call spread, and it's going to be a credit spread in this case. And it's going to be looking at, let's just go out near term, Rick. So I want to look at the calls, and I want to look at August. So I'm talking very near term here. And what I'm going to look at is I'm going to look at a strategy in which if the yen, if we see on that pair, if I see the price continuing to go lower, which is, of course, the strengthening of the yen, the weakening of the dollar, if I believe that long-term trend is going to continue or even go sideways, it will end up being a profitable trade upon expiration. Now remember, these are European style, so I'm not going to have the fear of early assignment here, but I still need to manage the risk with it.
Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.